everyone, and welcome to a tech-focused and centered look at whether it makes sense to buy now or wait. We're going to look at the data, and we are super lucky because we are joined by our favorite tech-focused lender, Dave Byrd. So I'm going to jump in and get us started. We'll take it away and let Dave speak for a bit. And we are off and running. The real cost of waiting in the Bay Area. So again, thank you so much for being here. Today we're going to talk about what it means to put off your purchase. And in particular, we are going to focus on our tech buyers because there are a lot of specific tips and tricks that really demonstrate that you are very well positioned when you're coming from the tech industry. So today we're going to talk about folks like yourselves who are in that in-between place, who are earning well. Maybe you thought about buying, but you're not sure if now is the right time. We're going to walk through the data behind that question. We're going to look at the Bay Area market has actually done over time, what it costs in real dollars to keep renting while you wait, how your compensation as a tech professional works in your favor in ways that most people don't realize, and what the market landscape looks like right now. My goal is that by the time you close this, you'll understand the full picture, and whatever you decide, you're making that choice with accurate information. While you're here, I'm going to go ahead and turn it over to Dave. Dave, maybe you have a couple ideas that you'd like to share before we get too deep in the meeting.
Absolutely. Thanks for having me. Appreciate the time and everybody joining in. The conversation that we are having oftentimes with buyers in this market is, waiting. If you look at historically at home prices, they just don't go down in the Bay Area. And so a big thing we're talking about with clients is the best time to buy oftentimes is if interest rates are elevated. You can buy when rates are elevated and there's less competition, and then you refinance into a lower rate in the future as rates go down, and it's much more competitive at that point because you're going to end up paying more for the home if you're buying in a competitive market with multiple offers on a property with lower interest rates than you would if you bought when there's less competition and higher rates, and you're refinancing 6 months or a year down the road when rates decrease. We have seen the market very much roller coaster recently. We had a significant drop in interest rates, very short period of time in February. Rates got down to their lowest point in 3 years for about a week. And then, we entered into the war with Iran and rates skyrocketed. The stock market did poorly and the bond market did poorly at the same time. That's actually very rare that happens. So it was a combination where people were losing money on stocks and interest rates were increasing. So, but we're still seeing multiple offers currently on a lot of properties. There are properties sitting without any offers in areas maybe that aren't as desirable, or maybe the property itself is not as desirable. But we're big on having conversations with the clients individually about strategies on how they can get their offer accepted. A big thing I like to talk about is, the minimal difference in the monthly payment. If a client goes from, let's say, $1.5 million to $1.550 million, but $1.550 million gets their offer accepted. Over time, that $50,000 is so it's really insignificant in the grand scheme of things. you'll have slightly higher property taxes for the life of owning the home, but the monthly your borrowing costs will go down eventually in the future, especially if you're refinancing to a lower rate. People's stocks have lost more money in the past couple of weeks than an eighth or a quarter or so on an interest rate, or even 3/8 of a percent on a loan that you may only have for a couple of years. So that's really like the conversation I'm having as of April 1st for the last month, because conversations about where the market was a year ago or rates, they don't really apply to what's happening currently. So just kind of a quick overview of where things are from the interest rate market standpoint.
Love it. Yeah, and it is really interesting because, there was a lot in the news about rates having plummeted, and their idea
Mhm.
of plummeted was going from a little over 6 to 5.98, which I know I've
So
got lots of
right,
numbers people on the call, so we know
right,
that that's
right,
basically the same
right.
number.
Right. And yeah, it's I mean, we see this. I've been a mortgage banker for 23 years. We've seen this how, you know, really the difference in your payment is going to be the sales price. So if you basically for every $10,000 in sales price, it's about $60 a month on the mortgage. So if you have, an $8,000 mortgage, I'm just throwing out a number here, and the difference in a quarter in rate is 125 or $150, and the borrower uses the wrong lender, or they offer $20,000 less than the next offer, they're looking at a very insignificant amount on the mortgage that keeps them from getting the keys. And what happens is, obviously you jump into a scenario where you go from one house to the next, and there's multiple offers on both homes. And if it's in the same area, you're probably competing with the other buyers that lost out on that home. So there's really small tweaks that a buyer can do to get them keys. The thing we talk about, it's all about the team that you work with. The team that you work with the realtor and the lender, is going to really factor in whether or not you get the keys to the home, especially if your offers are competitive. Um, so
And that's such a funny phenomena where you like offer on a place, and if you don't get it, you all keep going around as a group
right,
to
right,
all the
right,
properties,
right.
and
You might as well just
somehow,
caravan to the next offer.
yeah, and somehow that group never seems to
Yeah,
get any smaller. That's
yeah.
that's the problem.
Well, and oftentimes, quite frankly, if we miss out, whether we miss out by a lot or a little bit, we're going back and having a strategy about, hey, what can we do to where our next offer is accepted? Because as there's other, seasoned realtors that are going to have that conversation with their clients, and next thing you know, you end up bidding even higher than where you wanted to go on the previous property.
That's
So
absolutely right.
we talk about making a winning offer from the very start. Because as you know, there's, 6 offers are not going to get countered. Right now, they're just going to take the highest offer and everybody else moves on. They may counter one or two, but you're not seeing a situation where 5 or 6 offers are being countered. There's not always transparent pricing. This market really takes a strong team to help buyers get their offers accepted.
Absolutely, a sophisticated lender and
Mhm.
agent.
Yeah.
And I was just noticing something kind of funny as well, which is, when the rates went down, there was a flood of people coming in, but it seems now that they've ticked up that, whether it was half a percent in over 24 hours, it seems
Hmm.
like they're continuing to flood in because they're like, oh, yes, okay, what my expert was telling me is
Yeah.
correct, right? They
Yeah.
told me to get busy 2 weeks ago, and
Yeah.
I, hesitated, and now, the situation is different and looks like it will continue in that direction.
Yeah.
So,
Yeah.
it's really all about, instead of focusing on where exactly the rate is today, it is your personal scenario. And
Hmm.
if it makes sense and is possible for you to buy now, then you should do that, right? If your
Yeah.
job is
Absolutely.
lined up, you've got
Absolutely.
some funds set aside,
Hmm.
and even the funds nowadays, because there are, down payment assistance programs. So even those aren't things
Yeah.
that necessarily,
Hmm.
keep us from moving forward.
Hmm. Absolutely. I mean, it's just and even with a 0.5% increase in rates from the end of February or the first couple of days of March up until now, I mean, we've had a little bit of relief over the last day or two, but let's just say 0.5% difference in rate, very significant increase. And with that, we still had a ton of people trying to get pre-approved. So again, I mean, if you look at your stock portfolio, you lost a lot more money in the last few weeks than you would uh, a quarter or a 0.5% on interest rate. And even small things like insurance, we talk to clients about getting insurance quotes up front because if somebody has an insurance quote at 2,500 or 3,000 and they think that's the number and it ends up being 6,000 or you have to get a California Fair Plan,
Right.
that difference in the insurance is actually as much or more than a 0.25% in interest rate. So
Wow.
the thing I talk about is sometimes nobody ever calls me back and says, you know what, Dave, I should have kept renting for another year. They all say I should have bought 4 or 5 years ago.
That's right.
So nobody calls and says, I wish I would have stayed a renter.
That's right. That's right. Yeah. What is
um,
that saying? Like, when was the best time to buy sometime in the past? And, when is the next best time to buy
yeah,
now?
right. Exactly. Exactly.
Well, Dave, thank you so much for
Yep.
your time today.
Yeah,
Will you
absolutely.
do me a favor and just give me your name and your company and where folks can reach you?
Yeah, absolutely. Dave Byrd, Byrd. I'm at CrossCountry Mortgage in Berkeley. Been in the East Bay for 23 years. Best number to reach me at 510-647-5335, or you can email me at david.byrd, BYRD@ccm.com.
Love it. Thank you so much,
Okay.
Dave. All right.
Thank
We'll be
you.
talking.
Appreciate it. Take
All
care.
right. Take
Bye.
care. All right, so we're going to jump on in to our presentation today. Hopefully, I will be able to share my screen. All right, so buy now or wait. All right, so we've talked about this. Yes, so for those of you who do not know me, my name is Tia Honeycutt. I have been a real estate broker in the San Francisco Bay Area for 20 years. I'm not going to reiterate what's on the slide, but I primarily focus on residential, but I do also do commercial, which would be like ground floor retail with units above, or like 15 units or more types of properties. But my wheelhouse is really anything that somebody's going to live in, whether there's retail downstairs or it's a single family dwelling. And I've learned a lot about the real estate market here in California and the San Francisco Bay Area in particular. So it's been an incredible journey, and I am so very excited to share that journey with you all and what I have learned. I also have many, many family members in the tech space, and it is a space that I absolutely love and adore, and I love and adore working with my tech buyers and my engineers. And so I figured it would be an excellent idea to put forward a training just for them. So that's where we are today. So the main question that everyone is asking, how much can I afford? Right? That's what everybody really wants to know. So on the left there, you see the Bay Area median price is sitting around 1.2 million. That is a real we have to be careful about the numbers, right? Because the numbers often hide the true story, right? So 1.2 is probably a good number to look at as far as a median, but we're going to dig very deeply into what and where. On the right, you see a range, right, for tech workers, right? So you've got 180K approximately. Obviously, I know there are folks that are making less, and of course, you see up to 300,000 folks that are making more. But of course, those numbers are before you factor in RSUs, ESPPs, and bonuses, and it's generally these incomes are exceptional when you think about the whole nation, right? So you really have folks here that are making quite a bit of money. Now, the mismatch that people feel in regards to whether or not they can purchase isn't usually about the income that they're bringing in. It's about uncertainty. What if prices drop? What if rates fall? What if I save for a bigger down payment first? And those are rational questions, and we're going to answer all of them with data over the next several slides. The goal here is to understand what the cost of that uncertainty has historically been in real dollars. All right, so this is a very interesting slide. What this shows you is over the last 20 years, 25 years, I've been in the market for most of this. I came in, I don't know if you can see this right here, but I came in right about here, about 2008, when things were at a very low, right? Um, Now, when we talk about timing the market, I'm sure you've heard that before. What that is when someone is trying to, and everyone does it, they try to see when they can come in when interest rates are exactly at some arbitrary number that they feel is a good interest rate, quote unquote, and they try to time it so that they hit right at the time when the interest rate is at that number and the prices are at their lowest. That is impossible because you have to try to hit two things, right? You have to try to hit when interest rates are low and when prices are low. And usually you don't have necessarily those two things happening at the same time, unless there's some sort of calamity, which of course nobody wants because you want to be employed when you are undertaking this task. And a lot of times when there's a calamity, you're not employed. So, um, two major crashes, right? The dot-com bust in the early 2000s, that's this lower number here, and the 2008 financial crash, which was right around here. Okay, and so right, it took a while for the prices to slide based on the crash. And when you look at the slide, though, it didn't really go too low. I don't mean to understate it. It was a very difficult time, and thankfully the markets learned from that. There were a lot of tricks and like quantitative easing and things that Wall Street basically learned to put into place so that when COVID came around, right? So this is where we hit COVID. Instead of having another fall, it actually went up, right? Because they were able to make it so there was enough money in the economy for people to do what they wanted to do, which was when they were at home, they looked around and said, wait a minute, I don't have enough room. I have to go in the closet and Zoom because the kids are running around like crazy and, there's too much talking and there's people are trying to make lunch and things like that. So instead of a collapse, right, because there was, they call it a liquidity, a lack of liquidity, we had the other situation where everybody was buying and selling because they realized their properties were not working for them. So it just gives you a sense of when there is money for people to borrow, they're going to invest in real estate. So anyone who bought at the 2008, 2006 peak, quote unquote, and actually held through 2012 and was underwater for a period, but by 2019, they had doubled their equity. So the practical lesson here is that the Bay Area has a structural supply problem, right? So we're like, how does this keep happening? How is it that the prices, even in a major economic shock, don't fall very low? And we'll look at that on the next slide. Um, Now, maybe not an upcoming slide. All right. So, if you look at someone, for example, who had bought in 2019, they had a $900,000 purchase. They put 20% down, and that is 180,000. Of course, that is a real stretch, but it puts you in a position where it's achievable with a tech salary. At their rate locked in at 3.7, which puts their mortgage at about 3,600 a month. Fast forward to 2025, and now that very same home is estimated at 1.17, right? Or in this particular slide, they probably had to bid up to 1.2 to get it, right? 1.2. So that is 270,000 in equity growth. And if you had bought at this time and held, you would be building your principal, right? Paying down on your principal the whole time, right? So now if you look at the buyer on the right, they actually waited to buy until that time, right? So again, as I said, you had to bid up to 1.2 to be able even to get the same home, right? Now, if you purchase at that amount, now you've got to put down 240,000. Your mortgage is 6,200. Your rate is 6.5, which historically isn't that bad, but it's certainly more than 3.75, right? And you actually ended up paying 60,000 more just to get your foot in the door. And of course, you had no equity gains. The other issue is that if you waited from the 2019 to 2025, you also paid 6 years worth of rent, which in the Bay Area is a lot of money. So let's look at the differences as far as different counties and areas in the Bay Area is concerned, because it's a big area and there's a lot of difference. So that's why I was saying the 1.2 is a good number for conversation's sake, but it doesn't really tell us the full story. So when we take a look at this slide, you can see Silicon Valley, right? That's really, really the belly of the beast. So that's where your largest home prices are going to be. San Mateo County, a little bit up from there, but still right between San Francisco and Silicon Valley. Honestly, I would say statistically, these three are all right about the same. San Francisco also right now, very recently has gone crazy. It's gone absolutely crazy, particularly in the northern portion of the city. So very, very high prices there. Properties with 80 condos with 80 steps to the front door, have been going 1.8 at 2, 3. I mean, it's just nuts. But you do still have some other areas that are worth looking at, right? So if you can compete in these areas, why not? But I just want to call your attention to there's more to the Bay Area than San Francisco and the Peninsula, right? There's the East Bay, right? Which is Alameda, which includes Oakland, Berkeley, El Cerrito, right? And then you have Contra Costa, which is a little bit further out. That would be on the other side through the Caldecott. That would be your Walnut Creek, Lafayette, Orinda, all of these a little bit less expensive there, right? And then Solano, which is your includes Marin County, but also includes other areas on the in the North Bay. We call that the North Bay, right? So there's a lot of really nice options in the North Bay as well that you can consider so that you don't have to necessarily be at this in the Heights. Now, renting versus owning. This is a great one to talk about. When you're thinking about the fact of how much you're paying per month, rent and a mortgage look the same, right? When you're looking at them on paper. But what they're doing with your money is much different. When you rent, every dollar leaves and builds nothing. When you own, a portion of every payment builds equity. You get a tax deduction or mortgage interest and on mortgage interest, and you're protected against rent increases. Your payment is fixed. Your landlord's ability to raise your housing costs drops to zero because you are the landlord, right? So this bears repeating. One of the best things in particular about a 30-year fixed mortgage, if you get that, there are some adjustable rate mortgages, meaning they're fixed for a period of time, 5 years, 7 years, 10 years, whatever the term is. But the old tried and true really is the 30-year fixed. And the reason why, even if you do decide that you want to refinance out of that loan, you can. But it's nice to have the idea that for the next 30 years, I've actually seen 40 years loans, you are going to have a set monthly payment as opposed to rent, which goes up whenever you're either around here because we have rent control, when your landlord is allowed to raise it, which is a CPI increase every year. Or in other areas that don't have rent control, it can just go up whenever the landlord needs to raise it, feels that they need to raise it. So this is the great thing about buying is having a fixed housing cost. Another great thing about having a mortgage is it's almost a forced savings program, right? And that's another way of looking at equity, is as your house is gaining in value, you still every month you're putting in that mortgage amount, and that mortgage amount that you're putting in continues to grow your equity over time. So as you can see here, there's a couple of options where let's say you're renting a one bedroom in San Francisco, about 3 grand a month. Um, you've got zero equities, zero tax deduction, no protection from rent hikes, no long-term price lock. Whereas if you're paying, let's say, 6,200 if you do the 1.2 million property, or if you decide to do a property that's less expensive, then you're going to have a less expensive mortgage. And if you put more money down, you will also have a less expensive mortgage. You've got some costs as far as property tax, and you've got, other costs as far as maintaining the property. But you know what your monthly housing payment is going to be. Every payment is building equity. You get a mortgage interest deduction on your taxes. If you decide to sell down the road, then you get 250,000 as an individual or 500,000 as a married couple, tax free. Right. So let's say your equity over time, let's say 2 years, 5 years, because that's in the Bay Area, that's a lot of times how quickly properties gain equity. You have 500,000. Um, if you are a married person, that you will have an exclusion from your taxes, meaning your tax liability will now not count that first 500,000, which is incredible. Another thing to bear in mind is when we talk about Prop 13 in the political space, what Prop 13 does is prevents you from having your property taxes go up and up and up and up, based on the whim of the county, right? So that's a big deal as well. All right. Tech worker advantage. All right, so let's talk specifically about some of the deals that tech workers get and how you can use these for purchasing a property. So this is where you have an advantage over a other first-time home buyers outside of the tech industry. So RSU vesting, it's as a down payment strategy. If you have a 4-year grant with a 1-year cliff, your biggest single event cash infusion is predictable. A senior IC at a public FAANG company might be vesting 60,000 to 100,000 or more per year. The smart move is to plan your purchase 6 to 12 months after each large vest. You've had time to let the shares settle, pay taxes, and convert to cash. Don't buy right before vesting, however, expecting to use those proceeds because the timing risk might be too high. Now, as we get into these specifics, I do want you to have this conversation with your lender, and as you are shopping for a lender, make sure that's a question that you ask is, are you familiar with tech workers and tech workers' income and how we have income, right? Because there are ways to utilize the income even if it's not in your pocket, to utilize future income, especially if you change from one employer to another, but you stay in the same field. You don't have to wait the 2 years as is required with some other things, but I'm getting ahead of myself. So ESPP liquidation. Okay, most employees don't optimize this. The 15% discount means you are guaranteed a return on every offering period. Treat each offering period as a structured savings contribution to your down payment fund. So over 18 to 24 months, this can generate 30,000 to 80,000 depending on contribution limits. Offer income qualifying. Okay, this surprises people. If you just accepted a new job, so this is what I was talking about earlier about not having to wait. If you just accepted a new job at a higher salary, you do not need to wait 2 years. Lenders, especially those who can work with tech buyers regularly, can underwrite on your signed offer letter, your start date, and your comp structure. This is very useful when you're stepping up from, say, 150K to 240 and want to buy before you've technically started the job. Very cool trick. The other one that I want you to think about is restricted stock in underwriting. This one's pretty nuanced, but unvested RSUs are not income, but vested RSUs that have been paid out on a recurring schedule, particularly if your grant history shows consistent distributions, can be treated as income by certain lenders who specialize in this. And this can meaningfully increase your qualifying amount. All right. So, one more on appreciation versus rent growth. Again, this is just another way of looking at some of the information that we saw. A home bought in 200 at 900 in 2019 versus an estimated value of 1.175. That's it could be kind of on the low side actually, as far as what I'm starting to see in the market. But for these purposes, it's a pretty good idea to have, right? Um, and then when you compare that to renting, right, for in Silicon Valley or wherever you paid, wow, over that period of time. $250,000. Incredible, right? That would make a very nice down payment. And so then as you can see, the amount of money that you would need to afford a median home in 2019 has gone way, way, way up, right, in that 6 years, a period of 6 years. So that's important to bear in mind. All right, so we talked about this a little bit earlier. Why do these prices keep going up in the Bay Area? We have a couple of factors that I just want you to bear in mind so that you can um, feel at ease in regards to some of these prices, because I know, especially when you come from somewhere else or when you're starting to think about home prices, you're like, geez, that's pretty pricey. Is that something that can be maintained? Especially when you compare it to areas outside of the Bay Area, right? Area pretty much anywhere else besides Hawaii and maybe New York. But yeah, we're definitely, I think now the most important, most okay, that was a Freudian slip. Most important, most expensive place in the country. But there's a couple of reasons, right? Number one, geography. The San Francisco in particular is literally surrounded by water. But then as you move down to the peninsula, the South Bay, they at least are still surrounded on two sides by water. And even when you talk about the East Bay, right, you're very quickly you run into protected areas, right? There's regional park. These are open spaces that you cannot build into. So you might have a little bit more breathing room in the East Bay, and you do, and lots of lush green areas, plenty of trees, sun, gorgeous, gorgeous part of the Bay Area as well. But even there, you can't build into the regional park. And why would we want to? Because we wouldn't have the gorgeous deer and the turkey and all the little animals coming running out of the park that we can take a look at. But so you can't sprawl the way you can in a Phoenix or a Dallas, and that's why homes are so much more expensive here. Number two, zoning. Three-quarters of residentially zoned land in the Bay Area is reserved for single-family homes. Density bills and ADU law changes are helping at the margins, but a meaningful supply increase would take decades of consistent permitting. So while there is attention on building more, we're so far behind now. We're just not we're just not able to catch up. Employer concentration, and this one is something that's really overlooked, right? The Bay Area isn't just home to big tech, it's the headquarters of global tech. These companies do not relocate easily. As long as Apple, Google, and the startup ecosystem anchored to Sand Hill Road are here, high income demand persists. And honestly, I feel like if they went away and went somewhere else, we'd invent something else because that's just kind of our thing here, right? It's the San Francisco gold rush. We're always coming up with something. So it's always been the case here that we've had some sort of industry that's really been an economic anchor and is the reason that California is the number four economy in the world. You have structural scarcity. There's 7 million people trying to fit into, 2,500 or 25,000 homes that change hands annually, right? So I'm not saying there's 7 million people trying to buy 2,500 homes, but what I'm saying is there's a region of 7 million people and only 25,000 homes sell every year. So that means that there are definitely situations where people are not able to get into the homes that they want to because, of course, the high demand homes are the ones that everyone wants. So this is how we'll position you. All right, so rates. One of the big reasons, one of the most common reasons buyers are waiting is rate anxiety. It's worth spending real time here because there's a widespread misunderstanding about what normal looks like. Okay. The 20 and 21 rates, the 2.7 to 3%, were a once in a generation anomaly driven by a Federal Reserve emergency, of course, which was COVID, right? There were not there. That's not a new normal. That is something that was done. And remember when I was showing that other graph and I was saying that we had been here before, right, in 2008, and there was a lot of hand wringing and what do we do and how do we, and all that was happening. The world economy was going south, right? Well, they learned from that and made sure that it didn't happen again. And one of the tools that they used, in addition to some back end machinations, was the things that were very obvious to us, which was the prime lending rate being right around the 3%. Now, when you zoom, but however, if you zoom out further, right, and you look across the last 40 years, 6 to 7% is exactly where rates have historically lived. Buyers in the 90s bought at 8 to 9%. Buyers in 2006, the previous peak, were buying at 6 and 6.5, which is exactly where we are. Home ownerships worked at those rates, and people built wealth at those rates. The more important concept here is that you date the rate and marry the house. All right, so you've probably heard that phrase before, and what that means is when rates drop, because there's usually always some reason that they will, right? That's the time you run in and refinance. And you make the decision to move forward based on your scenario, not some macroeconomic um, policy that you can't control, right? What you really want to look at and use as part of your strategy is if your financial picture is together and you feel ready. And that's really the most important thing. All right. So, how do we get ready? How do we get ready to buy here? What are the things that you should be doing right now? Know your buying power, right? Take a look at different areas, right? Leverage any employer home buying programs. This is one that I really wanted to focus on as well. Most employers, whether it be Google, Apple, but at Stanford, a lot of employers do have programs because they realize that it's difficult for folks to get in the market, and they realize that an employee will be happier and more capable of seeing if they live nearby and they own the property that they're living in as opposed to renting and having the rent being jacked up every year. So, um, please do reach out to your HR team and see if there are some programs that can help you in the home buying space. And a lot of times they have really, really incredible programs. Another thing that you're going to want to do is think about considering using an arm. I mentioned that earlier because a 30-year fix might be a more expensive product in terms of your mortgage, your monthly mortgage. So do look at the 5 or 7 year arm because you're likely to refinance anyway. So in within that period of time, so it might be very helpful to you to be able to get a loan that is less expensive for the short term, and then when the rates drop, refinance into a 30-year fixed at a better interest rate or a lower interest rate. Let's see. Oh, yes, this is one of my favorites. What can you afford? Um, so what we're going to take a look at is, so if you're, where do you fall in this chart, right? If you are making 100 grand a year, then your down payment, again, this is based off of a 20% down. You do not have to put 20% down, I will say. But as you can see along the top here, it's saying 6% interest rate, 30-year fixed, 20% down. 28% front end, debt to income ratio. I know that there are some lenders that can do a higher number than this to make it easier to qualify. And then they've got, a property tax. Property tax varies by county. So depending again, because we were looking across a couple of different counties, you'll want to check in and see what the rate for your particular county is, but it's, somewhere in that range. And then they're saying 200 a month insurance. It's probably going to be more than that because the insurance companies are having problems. But yes, this will give you a good sense, right? So, this starter home price here. That's going to get you into a condo. That's going to get you into Solano County. As you can see down here in the bottom, it's giving you a sense of where the areas are that you can land. Again, same thing here. Now you start to poke into some other areas, right? A few more counties. And then 1.1, right? Now you're starting to be in a situation where you have quite a few options as far as areas. Folks usually choose condos because they don't have to worry about maintenance with roof or foundation or grounds or anything like that. You do have HOAs, which need to be calculated along with your mortgage so that the lender knows that you can afford both, right? So they will take that into account, and so that will push your number down a little bit as far as your qualifying. But then again, what you're getting for that is a situation where you're not having these other maintenance costs that might arise with a single family property. All right. So the bottom line, prices are resilient, but so are you. So, you're going to keep working. Rates will come down. If your income qualifies now, you're in a great place and really, really should look at whether it makes keep sense to keep forking out the dough as far as the rent is concerned. And there are a couple things that you can be doing right now, right? So number one is to find yourself a great realtor, right? Because there's really five steps that you need to take, and the realtor is going to help you with each one of those steps. And when I mean realtor, I mean real estate agent, but I mean one that's affiliated with the National Association of Realtors, because the National Association of Realtors has a code of ethics, and some great training, and really all of the best agents that you're going to come across here in the San Francisco Bay Area are going to be realtors, because all of their brokers require that. But that's at at a very base point. We want to make sure that the real estate agent that you're working with is a realtor. As far as where to find a great agent, friends, your employer, family. I'm leaving family towards the end. And then the internet, right? Because your friends really are a great resource, because if they have worked with someone that they like, you're probably going to like them too, right? Your employer might have resources. They might not only have a program that helps people buy, but they might also have a few realtors that they have a relationship with, and that they know understand their program, and understand what folks coming from their company need. So that's a great resource as well. And then, of course, family. Family usually has people as well, so you can always do with them. And then, of course, we all love the internet and Instagram, and you do get a pretty good sense of someone's vibe when you're seeing them online. So that can be a great place to meet someone as well. Your next step after that, which your realtor will be helping you with, is getting pre-approved. Right. So the pre-approval is the time when we're really going to be able to sit down and sort through all of your offerings and vesting schedule and all that good stuff, to see exactly where you do land as far as your pre-approval is concerned. The reason you want to do that first The reason you want to do that first before you start shopping is because even though there's not enough properties for everybody who wants them, there's a lot of different directions you can go running in, right? So if you know your number, then you can start eliminating counties, right? And then you can really kind of zero in on the type of property. So I find for my buyers in particular that pre-approval, the budget really determines where they look and what type property type they're going after, whether it be single family or a condo. Then while you're doing that, right, you're not going to get a pre-approval unless you have talked to a lender. So make sure that when you do interview your lenders, there's a lot of great ones. If you've got your realtor first, they have folks that they will refer to you based on the type of income that you have. And then, just make sure that you're clear with your realtor. Remember, I'm in the tech space, so I need someone who has that expertise. And then again, when you talk to your lender, make sure I'm in the tech space. So I just want to remind you. So I have some different kind of income that's coming through, and I want to make sure you have some expertise in that regard. And then after you have all of that information, now it's the fun part, because you ate your vegetables and now it's time for dessert, which is the shopping part. So now that you know what your budget is, and you have a sense of where you want to be, now you can, put in your parameters on Zillow or whichever platform you like. Some agents also have their own platform that they will sign you up for. They'll ask you minimum beds and baths. We've zeroed in on a budget, and then you're good to go, right? And so then you'll get automatic emails that alert you as new properties are coming on the market. There's no new set day for new properties to come on, so that's why the whole idea of leveraging the internet has been incredible. I came in before that was a thing, or actually, I came in right as it was taking off, and it is so much easier than like calling around, or although there's a fair bit of that we have to do as well. But the vast majority of properties are going to end up on the MLS, which is what we look at when we're looking at Zillow or Redfin or Realtor.com, or our agent's particular website. And it needs to be that way, right? Because people will put something in on Monday, they'll put something on 11 o'clock on Wednesday, they'll put something in on a Friday, and we just want to make sure that you're seeing these properties as soon as they come on, that you're able to look at them and decide whether it's a property that's of interest to you. So those are your steps. Thank you so much for your time today. If you want to get in touch with me, this is my phone number. This is a QR code for our company website. Our listings are on there as well as our team. And then also this video will live on YouTube forever. So here is my YouTube channel so you can access not only this slide deck, but as well as the other ones that I have done. I usually try to triangulate all the different aspects about real estate and really dive deep and talk about them. So that's where they live. And then my daily posting is on Instagram, where you will see some of the properties that we are buying and selling for our clients, as well as, every now and again, once a week. I will do again another deep dive on something quick, usually 30 seconds or a minute, about something interesting that's going on in the news or all real estate related. So thank you so much for your time and have a great day. And I'm going to turn off my screen sharing and wish you all a very happy day moving forward. Alrighty, take care. Bye bye. Hello.